Welcome back to my channel. In this video, I'll be debunking 7 common myths about the stock market that might be holding you back from investing. If you're someone who wants to start investing but is afraid of making mistakes, or if you've already invested and lost money because of these myths, then this video is for you. By recognizing these myths early, you can avoid making costly errors and become a more successful investor. So, let's dive right into it. Myth number 1. You need to be smart to invest. A lot of people think that investing is only for the experts who can spend hours researching stocks, analyzing financial statements, and understanding complex terms. The world of finance is full of jargon that can seem overwhelming if you're not familiar with it. Sometimes I wonder if this jargon is just a way to discourage people from investing and taking charge of their own money. Is it there to make people feel like they're not smart enough to invest, so they either avoid it or pay someone else to do it for them? Don't get me wrong, I think there's a role for professionals in this field, as in any other field. But there's also a part of it that you should learn and manage yourself. It's your personal finance, after all. You don't need to have a degree in finance or hire a financial advisor to start investing. You don't need to know every detail of every company or industry to start investing. What you need is to understand the basic principles of investing, take the first step, and stick to it. Myth number 2. You lose money when the market crashes. If you've invested in the stock market and you see your portfolio down by 20%, 30%, or even 40%, you might think that you've lost all that money. But that's not true. You only lose money when you sell your investments at a lower price than you bought them. When the market goes down, the best thing you can do is to do nothing. Don't panic, don't sell, don't watch the news, don't read the headlines, don't check your portfolio every minute. All of these things will make you want to act on your emotions and pull your money out. But if you do that, you'll lock in your losses and miss out on the recovery. Unless you've invested in something really risky or shady that you didn't understand, there's a high chance that the market will bounce back and your portfolio will recover. The stock market is like a heartbeat monitor of the economy. If the economy is alive and growing, the stock price will fluctuate up and down, but overall it will trend upwards. If you look at the history of the market, you'll see that it has survived and recovered from many crashes, such as the 1929 crash, the 1973 crash, the dot-com crash, and the most recent ones in 2008 and 2020. Every time, the market has come back stronger. Myth number 3. Percentage gains equal percentage losses. This is a very common mistake that people make, and understanding percentage gains and losses over time is very important if you want to invest or are already investing, as it helps you measure your return on investment or your net profit or loss over a period of time. What many people do wrong is thinking that the percentage gain is the same as the percentage loss. For example, if you were down 50% yesterday but you're up 50% today, you might think that you're back to where you were 2 days ago. But this is not true. If you started with $100 2 days ago and you lose 50% of that, then you have $50 left. If you gain 50% on that $50 that you have, you're now at $75. So our minds can easily fool us, but if our stock has dropped by 50%, then it will need to rise by 100% to get back to the same price as before. Myth number 4. More stocks mean more diversification. There is a myth that the more stocks you own, the more diversified your portfolio will be. While this is true to some extent, the key is in how correlated these stocks are to each other. If you had invested in all leisure and travel companies before 2020, then your portfolio probably took a huge hit during the pandemic. Correlated stocks tend to move up and down together, but uncorrelated stocks tend to move in opposite directions. A portfolio of all travel stocks, for example, wouldn't be very diversified, because they would likely all move in sync with each other. So the key is to balance out any losses by spreading your money across different sectors and asset classes, such as stocks, bonds, metals, real estate, etc. That way, you have more opportunities to make money in any kind of economic situation. Myth number 5. You need to buy at the bottom. Despite what many YouTube or TikTok self-proclaimed stock traders say or try to convince you, nobody actually knows what the market is going to do. Timing the market is extremely hard and actually requires two correct decisions: when to get out and when to buy back in. In theory, it sounds easy to say that you'll buy in when the shares are at the lowest point, but no one knows when that point is. It's only after the bottom has passed that we know that that was the bottom. Hindsight is 20/20. So if you see a market crash or a market correction and you think that it will last for a few more months, then a good idea is to dollar cost average your investments into it. For example, instead of putting $100 into the stock market all at once, split that $100 into smaller chunks and put them into the stock market gradually over a period of time. That way, you kind of average out the price that you're buying at. Also, I hear some people saying that they're waiting for a stock price to drop to a certain level before they invest. There is no magical force that pulls stocks back to a certain price. All those support and resistance lines that you see on the charts are just psychological, not physical. The price of a stock is determined by the supply and demand of the market, not by some arbitrary number. Myth number 6. Buying because the price has fallen. When there is a market crash or a market correction, most stocks become cheaper. But buying every stock just because the price has dropped is not a smart strategy. Let's say you're looking at two stocks. Stock A reached an all-time high last year at $50, but has since fallen to $10 per share. On the other hand, you have stock B, which is a smaller company, but it has recently gone from $5 to $10 per share. Which stock would you buy? Most investors would choose stock A, the one that has fallen from $50 to $10, because they think it will eventually go back up to those levels again. But this is one of the worst mistakes you can make in investing, and we often do it without realizing it. Research shows that people are more likely to buy something when it is on sale than if it was priced at that lower value from the beginning. And that's because our brains are wired to think that the quality and the value of the item that we're getting is actually closer to the original higher price. So we think we're getting a bargain. But price is only a small part of the equation. The goal is not to just buy stocks that are heavily discounted for the sake of it, but instead buy high-quality growth companies at a fair price. Myth number 7. The stock market has an obligation. Whether you're a beginner who has a few $100 in savings, or you're an expert who has millions lying around, the stock market has no obligation to you. We invest in the stock market with the expectation that these stocks will increase over time or will give us a return. But there is no guarantee. And that's why rule number 1 before you start investing is to always have an emergency fund in place. This should be at least 3 to 6 months of your basic living expenses, just kept aside before you start investing that money. That way, if anything unexpected happens, like you lose your job, your car breaks down, your boiler breaks, you have some funds that you can use on a rainy day. And you won't need to tap into your investment portfolio or sell your shares at a loss just because you didn't have that emergency fund in place. So hopefully this gives you some ideas on pitfalls to avoid if you're looking to invest in the stock market. Thank you for watching. Don't forget to subscribe if you haven't already, and hope to see you in one of my next videos.